Welcome to This Explainer. Today, we're unpacking a really fascinating financial concept that honestly has the power to transform non-deductible personal debt into actual wealth. We're looking at a proven, highly structured strategy designed specifically for Canadian homeowners who also own rental properties. It's called the rental cash dam strategy. Now, if you own your primary residence with a mortgage and you also hold a rental property, you're in a very unique position. By the end of our time together today, you're going to understand exactly how this whole financial framework operates, what it takes to set it up, and most importantly, what it could mean for your annual tax bill. So what if you could make your personal mortgage tax deductible without spending a single extra dime? I know, it sounds almost impossible, right? Like some kind of financial fantasy. But I assure you, the answer to this actually lies in a well-established, entirely legal strategy that just utilizes the cash you already have flowing through your bank accounts. You don't need a massive windfall to pull this off. You really just need to restructure the plumbing of your finances. All right, let's kick things off with part one, the tale of two mortgages. Okay, let's dive right into this and look at the universal pain point that makes this strategy so incredibly valuable. You see, every Canadian who owns both a primary home and a rental property is basically carrying two very distinct buckets of mortgage debt. Bucket A is your personal mortgage. This is the financial black hole on the home you sleep in every night. The interest here is absolutely not tax deductible. You're paying this down with after-tax dollars, which means you literally have to earn significantly more just to make the payment, and you get absolutely zero back at tax time. It's a drain, taking money out of your pocket forever. But then we have bucket B. This is your rent-a-property mortgage. The interest on this debt actually is tax deductible because that property is actively earning you rental income. This is favorable debt. The interest is written off right against the income it produces.
Moving right along to part two, the cash dam solution.
So, the fundamental problem here is that most of your hard-earned money is trapped fighting the bad debt in bucket A. But imagine for a second if you could magically pour that bad debt from bucket A straight into the good debt of bucket B. Well, that brings us to the formal definition of what we're looking at today. Rental cash damming is a systematic redirection of cash flow that changes the route of your money to convert non-deductible personal debt into tax-deductible rental debt over time. And I really want to emphasize a key phrase here, changes the route. We aren't talking about changing the amount of money you spend, and you aren't taking on heavier burdens. You're simply changing the path your money takes to get to its final destination. To really reinforce this, let's look at a quote from our source material by mortgage expert Michael Q. Blair. He hits the nail on the head, stating clearly, it's not a trick, it's not a loophole, it's a systematic redirection of cash flow that changes the nature of your debt over time. This is a super important distinction. The deductibility of interest on funds borrowed for rental purposes is a well-established fact in Canadian tax law. So this is a totally legitimate CRA-established wealth-building technique. It is literally just a smarter way to manage your existing obligations. Now let's get into the nitty-gritty with part three, step-by-step mechanics. Now, what's really interesting is how this theory actually functions when you set it up in the real world. Here are the 5 mechanical steps. Step 1. You absolutely need the right structure. This means a readvanceable mortgage on your primary residence, which includes a home equity line of credit, or a HELOC, because as you pay down your personal mortgage, HELOC room opens up. Step 2. You redirect your rental income. Every single dollar of rent, instead of going into your checking account, is sent directly as a prepayment against your personal mortgage. This rapidly shrinks your bad debt. Step 3. You pay your rental expenses, taxes, insurance, maintenance, the rental mortgage payments, using the HELOC. And because you're borrowing to pay expenses to earn income, that HELOC interest is now tax deductible. Step 4. Repeat this every single month. Your non-deductible debt shrinks, and your deductible HELOC automatically grows. Finally, step 5. At your end, your accountant claims that HELOC interest as a rental expense, reducing your taxable income, and boom, generating a refund. Let's look at the numbers in part 4, the math and action. Okay, get ready for an aha moment here. Let's see how this builds into an undeniable financial advantage using a specific scenario straight from the source. Let's say your personal mortgage is $400,000 at a 5.5% interest rate, and your marginal tax rate is 40%. Your rental property brings in $2,200 a month. Its expenses are $800, and its mortgage payment is $1,400. Under the cash dam strategy, that full $2,200 in rental income completely skips your checking account and goes straight against your personal mortgage. Thanks to your readvanceable mortgage, $2,200 in HELOC room immediately opens up. You then draw from that newly opened HELOC to cover the $800 in expenses and the $1,400 rental mortgage payment.
So, the absolutely crucial point to take away from all this math: $0. I really want you to let that sink in. The net movement from your pocket every single month is exactly $0. You used $2,200 of income to pay down your mortgage, and you borrowed $2,200 to pay your rental expenses. You literally haven't spent a single extra dime, but you fundamentally changed the tax classification of that debt.
And this brilliantly illustrates the compounding power of that $0 change over time. In year one, you've routed $26,400 through the HELOC for rental purposes. The interest on that generates a tax refund of about $581. Nice. But in year two, your deductible balance grows to over $52,000, and your refund doubles to over $1,100. Fast forward to year five, and you have converted over $130,000 of bad debt into good debt. At this point, your annual tax refund is approaching $3,000, and it just keeps growing every single year. Zoom out to a 10-year horizon, and this completely passive background strategy can generate $20,000 to $40,000 or more in cumulative tax refunds, depending on your tax bracket. That is real money that you can apply right back to your mortgage or invest. And the source actually notes that if you have multiple rental properties, the math accelerates dramatically. Clients with 3 or 4 rentals can literally see annual refunds of $8,000 to $15,000 once the whole shebang is fully implemented.
Okay, let's bring it back down to earth with part 5, what you need now.
Incredible, right? But to execute this legally and safely with the Canada Revenue Agency, there are strict prerequisites you absolutely must have in place. You cannot just wing this. Here are the 4 critical requirements. First, the foundation. You need a readvanceable mortgage on your primary residence. Without a HELOC that grows as the mortgage is paid down, the mechanics simply fail. Second, strictly separate accounts. Your rental income, your personal mortgage, and your rental HELOC must be totally isolated. Commingling these funds destroys the deductibility argument with the CRA. Third, you need an accountant who actually understands this strategy to document that the HELOC funds were explicitly used for rental purposes. And finally, fourth, patience. As we saw earlier, the real power of this compounding shield really shows up in years 3, 5, and beyond. Now, to build some trust in this process, it's definitely important to address a few common variables. For example, what if your rent doesn't fully cover the expenses? Well, the strategy still works perfectly fine. The monthly conversion amount is just slightly smaller. But what if you sell the rental property? The rule here is super simple. The HELOC balance tied to those expenses remains deductible only as long as the rental purpose exists. So if you sell, the rental purpose ends. Your accountant will simply guide you through unwinding the structure using the proceeds from the sale. So if you're sitting there realizing you have both a personal mortgage and a rental property, you should absolutely explore this. The source highly recommends running your personalized numbers using the rental PashDem calculator available at michaelqblair.ca. That's going to show you your exact monthly DEM amount and project your cumulative tax refunds. From there, you can actually book a free consultation call to review your current mortgage structure and see exactly what changes are needed to put this plumbing in place for yourself. We'll leave you with this final thought to ponder today. Is your cash flowing in the wrong direction? For so many rental owners out there, the wealth is already there. It's just hidden inside their existing cash flow, waiting to be redirected. Thank you so much for joining me for this explainer. Keep learning, keep optimizing, and we will see you next time.